Today we are going to take a look at a company that has been punished by the market, and this company is not else but the very famous Nike. I'm not sure how you supposed to say it, but why it caught my attention that there has been some significant or not significant, it depends where you look at it from, insider buying from the CEO and also Timothy Cook, the very famous CEO of Apple. But obviously it's just a question if the company can turn back. But in this video we are going to look at why did the share price has fallen and if there is a possible opportunity for a great profit in terms of the share price increases. And we are going to use our very famous MetisOne for analyzing the company. We're gonna hop into the stock analyzer and just put Nike in the search, or Nike. Just let me know in the comments which one is the correct one to use. And we can see that the share price of the company has been falling in the past 5 years, and soon we are gonna get the picture why, and also maybe look at why did Tim Cook probably have bought the stock, what opportunity he sees on the long run. But of course this company has been punished by the market in terms of generally how the market is shaped. So consumer stuff is always hard if there is a possibility of recession. Consumers spend less, and also the tariff issue in the past 1 year has been struggling with the company. So uncertainty is obviously playing a huge role in terms of the pricing, but also we will see that their financials are not doing as great, and we will see if there is a possibility to come back. Is it early to tell? And then let's hop into financials, where you would see that from 2021 the company has been not growing. In the last 4 years the company has been actually performing pretty bad in terms of profitability and also in terms of revenue growth. This is something that the market really punishes, especially with a company like Nike, where the life cycle is probably around already the major growth, and they are hard to re-innovate themselves because obviously it's a huge company. So when we go to their net income, their net profits, we can see that it has been halved, a little bit over halved. It depends where, if you would like to look the TTM or the current price. It used to make a lot of money. Now it still makes a lot of money, but the circumstances have been differentiated because the revenue is same and the net income is halved. And you can probably guess that the costs and other costs have been going up, which is not as good for a company like this. So just let's look at quickly in the cash flows. As you can see, there has been a lot of costs going into paying dividends, for example, and also repurchasing stocks. But the repurchase of common stocks has been declining since obviously the company has to reinvest it to either trying to get back on the market, but just to also be making sure that everything is going fine. Their capex has also halved, so we can see some clear pictures that it's struggling, and it also has to come back, but also we are seeing that it's quite stable. So it's not a classical turnaround where there has been a disaster. It's just a situation where they are facing a few hard steps, for example uncertainty, and this has an impact on the share price and also on the company's performance. And also this is somewhere a cyclical performance, so we could see a rise in consumer spendings that will have obviously a very positive impact on the company. But currently, if you see, the market cap is quite large, $95 billion, and their PE ratio is around 37, and their forward PE is around 41, which makes it quite expensive. If we just look at the price to earnings ratio, we will go to the valuation very soon and you will see what do I think of it. If we look at their gross margins, 41%, it's quite amazing for a company at this size and this volume. Their net margin is 5.43. It's still amazing. I mean, like if you know the industry, having this number is great. It's not the best, and obviously if you would look at it to 2021 or even going back to 2019, you would have a higher net margin at that pace. And if we just look at the cost map, you can go back to many years. If you would look at the cost map, you would see a net income of 10%, or if you go back to 2017, even larger. So you see that the gap is going like tightening. And then if you would go to the current numbers, you would only see 5%. So it's shrinking. It's quite an issue for the company, but also it gives you a picture on how the company is performing. In terms of the growth numbers, you can see that not really has been going well. Nothing really has been going perfect. So there's no double digits in terms of averages. We'll see. It's hard to guess at this point. I think in 2026 we're gonna be much wiser in terms of the company. If we look at our valuation page, where we are going to use a discounted cash flow formula, we can put in the growth rate, which is going to be their projected free cash flows for the future, and then we are going to discount it back with the discount rate, which we're going to use the weighted average cost of capital, or shorten back. So let's suggest that there is it's not wrong, it's actually suggesting this number, and you can open it. Why? You can see that their average free cash flow is negative for the past 3 years, and this is understandable. They have been cut half, so if you would see their free cash flow growth numbers, it's struggling. And if we would just take a guess, if it stays on zero, and if the WACC is the suggested 10.4%, which you can also just read how it's calculated and why it's chosen, then you would get a picture that the company is still overvalued. But obviously, if you would just put in the, let's say, 25% growth rate for the next 5 years, we're talking about 5 years, you can see the projected cash flows just in the detailed version, where you would average around the 5 billion section. So that would be more realistic. Obviously, that would lead up to a share price of 71. But maybe if we are going with a more realistic, the 20%, that can sort of give us a picture. Yeah, it's bringing out to our current valuation. So let's just quickly check the sensitivity analysis, where we can sort of get the idea how we are standing, if there are more possibilities of growth or just more uncertainty. And I would say that the WACC is definitely going to decrease in the next years. Well, it really, I can't bet on it, but probably going to decrease. And also the share price growth is going to be determined on macro, and also how the company can catch up and how the trends will look. I'm not sure about the total picture, but I would guess that it could get better. The chance of it getting better is higher. But let's see that if, for example, their growth is only 16%, the scenarios that you would have the WACC coming down, it's not even gonna help you in the long run. So you would have to get around 20% growth at least, so that the most possible scenarios where the WACC would be coming down to 9.4 or 8.4, that would give you a chance of undervaluation. And if we just check quickly the scenario analysis, where we would get a more clear picture if what of the scenarios could be. Well, if you would go with the 25% growth rate, which is pretty good, that would mean that the company has performed a successful turnaround. That's the idea. That would bring you around $86 per share. And if you would look at the bear case, obviously that's when they would fail. That would be very bad, because the current stock price would probably just half. So, why did Tim Cook buy? I guess it's not a large amount of money for him, but it's not a huge buy, where it's not like, oh, he bought a very significant amount. I think it's a long-term play out. Nike has a brand that it's hard to copy. It's hard to say that it's not a real brand. They are historically great companies, so it's just a current issue of their life cycle. And they have a macro issue and also a political issue in terms of, in terms of risks growing, and also just how consumer trends are behaving is unclear. So if everything goes well, the company could be undervalued. In my scenario, I would not buy because I see more risk than possibilities. But I also get the picture that the past 3 years has been an ongoing struggling. So the next possible 3 to 5 years, if the management gets it right, it could be a great turnaround because they haven't lost a lot that they cannot turn around back. So it's a long term. I'm not gonna buy the stock. But if you have any opinions, feel free to put it down in the comment section and join MetisOne and do analysis like this in a matter of minutes, understand stocks and companies very clearly and value them and become a better investor by time. So if you have any questions, just put it down in the description, in the comment section, and I will get back to you and write down which stock I should choose in the next week's video. See you in the next one. Goodbye.